Welcome back to Market Plainly. So today, we have an absolutely fascinating explainer lined up for you. We're going to explore one of the greatest and honestly kind of the most unusual success stories in the entire history of modern retail. We are looking at a company that just consistently outpaces its peers. And the crazy thing? They don't do it by following the traditional rules of commerce. Actually, scratch that. They do it by completely rewriting them. So, here is the big question. How exactly do you build a retail empire by barely making a profit on what you actually sell? It sounds completely impossible, right? I mean, every standard business textbook tells you the exact same thing. Buy low, sell high, maximize those product margins. But as we'll see in the source material today, Costco chose a radically different strategy. It's a strategy that literally flipped the financial mechanics of retail upside down and created this massive economic moat that competitors are still, to this day, struggling to breach.
Okay, let's dive into this. Here is our roadmap for today's explainer. Number 1, the retail profit paradox. Number 2, the magic of limited SKUs. Number 3, the Kirkland Signature empire. Number 4, mastering the cash cycle. Number 5, investing in human capital. And number 6, Costco versus Amazon. Let's get to it.
Section 1. The retail profit paradox.
All right, to really appreciate what Costco pulls off here, we first need to understand the historical context of how a normal store actually makes its money. You see, traditional retailers rely heavily on product markups. We're talking usually anywhere from 25% to 50%, and that's just to cover their operational overhead and actually generate a net income. But Costco aggressively caps its markups. They average an overall markup of just 11%. They strictly cap national brands at 14% and their private label goods at 15%. They essentially manage their merchandise sales at near break-even levels. Basically, they're just covering the cost of the goods and running the warehouse. So you might be wondering, if they aren't making money on the actual products, where is all the profit coming from?
Well, it comes from this staggering number, $5.3 billion. Yeah, you heard that right. In fiscal year 2025, that is exactly how much revenue Costco generated purely from membership fees. And because it costs very little to maintain a membership database, almost all of that $5.3 billion flowed directly to the bottom line. Membership fees aren't just some nice little perk for them, they are Costco's true high-margin profit engine. So Costco built this membership-based business model that fundamentally changed the company's incentives. Instead of obsessing over maximizing product margins, they focus entirely on delivering pure value to customers to ensure those recurring membership fees keep rolling in. And man, it works. Costco recently raised its standard fee to $65 and its executive tier to $130, which, by the way, was their first hike in 7 years, and yet, their renewal rate in the US and Canada held remarkably steady at 92.1%. A huge chunk of this loyalty comes from that executive tier, which boasts over 44.4 million paid accounts. Sure, these members pay double, but they get a 2% annual cashback reward, up to $1,250. The math shows that a typical household easily surpasses the annual spending needed to offset that upgrade fee. Analysts view this as a brilliant self-reinforcing loyalty mechanism. It's basically a continuous purchasing feedback loop powered entirely by pure membership economics. Section 2. The magic of limited SKUs.
To see how this profit paradox builds into their unique operating model, we've got to look at the absolute magic of limiting choices. Think about it. If you walk into a traditional supermarket, you are just bombarded with choice. We're talking anywhere between 30,000 and 100,000 unique items on the shelves. Costco, on the other hand, deliberately limits its inventory to just 3,700 to 4,000 highly curated SKUs. So instead of stocking, dozens of different toothpaste brands, they might stock just 4 carefully selected ones. By pulling massive consumer demand into a single, focused product line, Costco's buying teams gain incredible supplier bargaining power. They achieve massive economies of scale and negotiate exceptional bulk discounts from suppliers. And those suppliers? They are more than happy to accept a lower unit price in exchange for guaranteed high-volume shelf placement.
And this limited SKU format, it also completely revolutionizes their logistics and operational efficiency. The average Costco store is massive, about 146,000 square feet, and they function as combined retail spaces and distribution hubs. Products arrive, they're stored, and they're displayed on the exact same standardized shipping pallets. This direct-to-floor logistics model is a total game changer. It completely bypasses the highly labor-intensive process of individual shelf stocking, which heavily reduces labor hours, distribution overhead, and overall operational costs.
Section 3. The Kirkland Signature empire.
Speaking of what is actually on those pallets, Costco's private label brand plays a role in their long-term profitability that literally cannot be overstated. Celebrating its 30th anniversary in 2025, Kirkland Signature has grown into an absolute juggernaut. It now generates approximately $90 billion in annual revenue globally. It captures roughly a third, or 33%, of Costco's total global footprint. It has legitimately become one of the most successful retail brands in the entire world, renowned for offering products with premium quality at significantly lower prices.
But the real strategic brilliance here is in the pricing and the immense trust it builds. Costco prices Kirkland goods 15 to 20% lower than equivalent brand name products. Yet, because it's their own brand, it carries slightly higher margin caps, up to 15%, compared to the 14% cap on national brands. So, as Kirkland grows, Costco's overall margin profile improves without ever having to raise prices on the consumer, which just cements that customer trust even further. Plus, it gives Costco vital supply chain flexibility. When tariff uncertainties or massive trade disruptions hit, they can just lean harder into Kirkland to absorb those rising import costs and protect their members' wallets.
Section 4. Mastering the cash cycle.
Okay, we are going to dive into some dense financial mechanics here for a second, but let's translate this incredible logistics efficiency into plain English. First up, we need to understand the cash conversion cycle. This is simply the number of days a company's cash is tied up in its inventory and operations before it gets that money back through sales. Now, traditional retailers, they tie up massive amounts of working capital for weeks or even months because their goods just sit on shelves waiting to be bought.
But here's where the real financial magic happens. Thanks to rapid pallet-based sales and high inventory turnover, Costco only holds inventory for about 27 days. And since customers mostly pay with credit cards, Costco gets the cash in about 4 days. And this is the kicker, because Costco is such a dominant sales channel, it can negotiate extended payment terms with its suppliers. That gives Costco about 30 days to actually pay them. Do the math here, and it results in a cash conversion cycle of just 1 day. Let that sink in. They literally sell the inventory and collect your money before they even have to pay the supplier for it. No way, right?
It's no wonder business analysts absolutely praise this dynamic. This creates what is called negative working capital. Essentially, suppliers are providing a significant financial advantage, acting like interest-free financing for Costco's day-to-day operations. This frees up enormous amounts of cash, allowing Costco to fund a massive expansion strategy entirely through organic operational cash flows. We're talking about impressive international growth, expanding their massive global footprint to 924 warehouses, building out dedicated business centers, and adding high-volume standalone gas stations. And they do all of this without relying on massive external debt.
Section 5. Investing in human capital. Now, because Costco is so incredibly efficient everywhere else, they're able to completely flip the script on traditional retail labor costs. Historically, as you probably know, retail is characterized by low hourly pay and super high turnover, but not at Costco. In 2025, they negotiated a new 3-year labor agreement with the Teamsters Union, with top-of-scale employees on a path to $32.20 an hour by 2027. When you factor in healthcare, retirement, and other excellent benefits, Costco's average hourly compensation for U.S. workers reaches approximately $46.
Traditional retail models will tell you that high labor costs crush your margins, but Costco looks at it totally differently. They treat their employees as an asset, not a minimized cost. This high compensation drives remarkably low employee turnover. By keeping tenured, experienced employees around, Costco completely slashes the massive expenses of recruiting and training new staff. These seasoned employees work faster, they work safer, and they provide vastly better customer service. Investing in people directly translates into higher sales productivity per employee and much stronger long-term financial performance.
Section 6. Costco versus Amazon. So in an era where digital channels absolutely dominate and consumer behaviors are constantly changing, how does Costco's physical footprint stack up against the ultimate hyperscale platform like Amazon or direct competitors like Sam's Club? Well, the contrast is staggering. Costco's approach is pure physical warehousing, budgeting a highly predictable $6.5 billion in capital expenditures for 2026. Amazon, on the other hand, to maintain its e-commerce and cloud computing dominance, committed an unprecedented $200 billion for AI infrastructure and data centers. Amazon's hyperscale model comes with immense reach, for sure, but also significant operational friction. That includes a historic $2.5 billion FTC settlement over subscription interfaces, ongoing antitrust lawsuits, and real labor unionization struggles. Conversely, Costco just continues to thrive through operational simplicity, clear pricing, and rock-solid customer trust, enjoying an insulated, low-friction efficiency. Look, both approaches have incredible strengths, but they operate in entirely different strategic universes. Which brings us to the end of our analysis. Thank you so much for watching. If you enjoy having business, finance, technology, and economics explained in a simple, engaging way, please make sure to subscribe to Market Plainly. And hey, I want to hear from you. Head down to the comments and let me know. Do you prefer Costco's model or Amazon's? And what company would you like us to cover next?
Before we go, I want to leave you with this final thought. Many business analysts consider Costco one of the absolute strongest examples of an economic moat in modern business. We just saw how memberships, customer loyalty, limited product selection, operational efficiency, Kirkland Signature, and employee satisfaction all reinforce each other. It forms a business model that competitors frankly just struggle to replicate. So, in an era obsessed with infinite digital scale, is Costco's disciplined physical simplicity the ultimate unbreachable moat? Really think about it. Thanks for learning with me today, and I will see you in the next one.